What's up, everyone, and welcome to another episode of the Prosperity Through Multifamily Real Estate Investing podcast. I'm your host, Cody Laughlin, and with me, as always, my friend, Mr. John Beatty. John, how you doing over there?
I'm doing wonderful. I'm looking forward to hearing about Spencer's real estate adventure and his background.
Yeah, absolutely. Yeah, very special guest today, Mr. Spencer Hilligoss. How you doing, Spencer?
I am doing great. I'm indoors, as many of you guys are. So I'm doing well. Thank you so much for having me here, guys.
Yeah, man, we appreciate you taking time on, and we're honored to have you. But before we get into your story, Spencer, let's introduce you a little bit. So a little bit more about Spencer. He is a passive real estate investor, multifamily co-sponsor, and former technology leader. His company, Madison Investing, has co-sponsored deals totaling more than 4,000 units for more than $500 million. Spencer invests in syndications as an LP and actively leads Madison Investing alongside his co-founder and wife, Mrs. Jennifer Morimoto. As a technology leader, Spencer built a 13-year track record of growing high-performing teams across 5 companies, 3 of them unicorns, valued at more than $1 billion. In November 2019, Spencer retired from his lucrative technology career, leaving behind the $4 billion loan origination teams he had built at Lending Home, funding 600 fix and flip transactions per month. Now he is focused on spending time with loved ones and growing Madison Investing by helping passive investors achieve their goals. So Spencer, very impressive resume, man. There is a lot of big figures in there. So I'm interested to learn more about you and how you built up such an impressive portfolio.
Yeah, well, thanks so much again for having me. I think hopping on a call and talking about this stuff is so much fun. And we were all just joking about before we started how we're trying to navigate business and working from home with having all of us young kids. So this is far more enjoyable to a degree talking about this stuff than just singing Wheels on the Bus.
Right.
But all the same, my journey in real estate has been a pretty quirky and interesting one. I didn't just wake up one day 4 years ago and decide to get into it. A lot of folks don't really know this, but I started in real estate technically when I was 6. My dad was a broker. He was a residential real estate broker, one of the top in the country in the 90s. And that was in the Bay Area, California, where I was born and raised, and I'm living right now. So I would see him hustle hard, built up that business. And, we were flying pretty high as a family growing up. But I would say that there was a time, in my teens, he'd been building a business and he was forcing me to work open houses in like multi-million-dollar mansions. And I just absolutely hated it. I would rather be hanging out with my friends and, go and doing what teenagers do. But it still stuck with me, right? Like the learnings of that period of time. But shortly after that, we went through some tough stuff as a family. We went through what we call like the dark decade. And it was triggered by predominantly my younger brother was diagnosed with cancer and he lived a very short, beautiful life. He passed away, and that triggered just a series of really challenging financial events. And I bring up all this stuff because those financial events were like, brother gets cancer. Unfortunately, he passes away, triggers a divorce because that's what happens most times if you study that stuff when parents lose a kid. And then the business my dad had built disintegrated. And so we had to downsize our whole financial livelihood, all that stuff. And so, I won't spend all the time talking about that stuff and getting heavy, but it's important because I'm a dad now. It's just like we were talking about. I have my own kids. And I got these principles kind of instilled in me just by watching what he went through. And here I am, I have this career that was a technology career as an operations and sales leader in Silicon Valley for 13 years. And I just kind of got into it because it was the local business. 4 years ago, about 2016, I was kind of nudged to go into my 5th technology company called Lending Home. That is the biggest fix and flip lender in the country. And I had no idea what I was signing up for at the time, right? I thought, oh, cool, another operations and sales group. I'm going to go kind of turn them around, hire a bunch of people, build them up, and call it another win. And I ended up just getting the real estate bug, and it was mostly about flipping because all of the loans we were doing when we got up to about 600 loans per month, 600 transactions per month, they were flips. So people were trying to talk me into becoming a flipper. And I looked at that and I'm like, dude, I can barely swing a hammer. I mean, I wouldn't be able to fix anything around my house if I didn't have YouTube. But I definitely know operations. I know spreadsheets. I know how to partner with people, and I know all that stuff. So I was really, really drawn to the predictability of multifamily, and I was really drawn to this combination of like growing up and seeing that journey that my dad went through and building a business and having it crumble, and then also seeing how you can get multifamily to be predictable. You know, you can build wealth slowly and deliberately over time, and that just really made sense to me. And so we started passively investing as LPs, as limited partners in other people's projects, and that eventually became a business. You know, we had friends and family in our network of tech folks, executives, and other, you know, engineers and all these other folks that, you know, that have pretty good high incomes and are looking for better investments. They wanted to know what we were doing, and they started asking about it. And so we actually built a business based on that for the last few years, and it was so organic. And so that's really flash forward to 4 months ago. I just 4 months ago quit my technology career of 13 years. And of course, didn't quite plan on it being 4 months before a black swan triggering an economy crash. But that said, we're in a great spot because of all the LP passive investing. And of course, my wife and partner, Jennifer Morimoto, she has her own, you know, thriving career. And so that whole picture puts us in a very good spot. And if nothing else, I hope that people take away the fact that when you plan well and you really work your butt off, and you're smart about the way you allocate your time and your resources, real estate can be a big part of a holistic strategy, you know, and it really can set you up well. So I appreciate you guys listening to that. That was a bit of a twist and turn journey.
Yeah, no, hey, listen, we appreciate you sharing your story, and you know, it's always tough to hear that the tragedies that some people go through in their stories. So I know that's difficult. So we appreciate, you know, that, and sorry to hear, you know, that you had to endure that, but, you know, we're so glad that you were able to, you know, find a way out of that and you know, make a successful business for yourself and your family. And congratulations on quitting
Thanks.
your job.
Appreciate
That's awesome. So
Should be some good opportunities coming up too.
Yeah, I know. I'm a pretty big optimist, you know, and I know it's a heavy time, and I know there's people really impacted, but all the same, what I've been trying to message to people is that this is not the time to recoil. You know, this is the time to lean in hard and to really, really, if you're, you know, if folks are brand new to real estate, if they've never invested in anything besides a 401k, this is when you should start learning. It's the perfect time to do that, man. Not just because we're all cooped up in our houses, but also because it takes time. It just takes time to learn the fundamentals. The people in 2008 and 9 that were impacted, they will tell you firsthand that, I mean, the real estate investors, they made huge gains in 2009 and 2010, all the rest.
Yeah. You mentioned your business started organically, you know, for family, friends, et cetera. Just what was the key drive for those folks, and what were you offering? Just an alternative, diversification, better returns? All the above.
You know, that's a good question. When we started, I think the income component was clearly a wake-up call to me. You know, I think a lot of people don't really get that because it's not something the mainstream kind of Wall Street 401k IRA investing machine really wants people to know, because they want you to funnel as much of your money, your hard-earned money, into 401ks so they can keep tapping the fees. So what blew my mind was I was like, what's this thing called cash flow? And it sounds so rudimentary for real estate investors that have been doing this all along, right? But for me, I was like, wait a sec. You're telling me if I reduce my contributions while I'm still working at the company, you know, I hadn't left or I hadn't built my career in real estate yet, and I hadn't left my day job yet. But we started to wind down our 401k contributions and drop money into these syndications, and also we bought some rentals up front. We kind of had to go through those learning steps. We still get cash flow off them too. So that blew my mind. Cash flow, the fact that I could go put money into something and have it come in monthly.
Mailbox money.
It was mailbox. I mean, everyone says that, and I was like, that sounds like BS. But it was not. I mean, so we went off and first just bought local. We got a duplex locally, and then we went and bought some turnkeys in the Midwest. We still have all those properties now, and they cash flow, but we still have to go manage the managers, right? So like we still have to get on the phone. We are dealing with an eviction in one of them now, but hey, they are all Section 8 and voucher programs. So anyone that wants to hate on that right now, I'm sure they're eating those words. I'm not concerned about our tenants paying rent right now. So I bring that up because cash flow is an educational point for a lot of folks, and it was for me too. So when coming back to your question, when we first started investing in these things and we get into casual conversations with people, they'd be like, wait a sec, I don't understand. Like you're getting monthly, you're getting a monthly, basically like a dividend. And I was like, yeah, I guess you can call it a dividend, but yeah, basically. And so that was the biggest educational thing first and foremost. Then the returns came along kind of after most discussions. The first thing was it pays you money and you don't have to wait to access it.
That's great. Yeah. So in your experience, so in our experience, you know, a 99% of people kind of don't know about private direct real estate and syndication and whatnot. So did you find the same with your
completely.
folks? Yeah.
Yeah, absolutely. I mean, it was, this is an interesting observation. I think specific to probably like maybe high tech industry, but certainly in the Bay Area, I experienced this. There's a heavy focus and population of folks that are very well educated. You know, I mean, we're talking like top 5 Ivy League schools. They go and start their own companies. They typically come from very, you know, high pedigree families, all this stuff. So they're used to winning. And as a guy that went to Boulder, University of Colorado Boulder, I'll be upfront. Sure, I have a little chip on my shoulder and I didn't take my academics as seriously as most folks. But hey, you know, I think that crowd of folks who came from hardcore academia and they earned every bit of those A's that they got, when they get into here, that they have not been aware of an investment you can make that pays you money at better rates than pretty much any other investment they have made. They don't believe you. Yeah. You know, they think you're not only wrong, they think you are probably making some pretty bad decisions. And so there's this interesting learning curve that kind of starts with heavy denial. And you got to just let that data speak for itself. We have a large and growing number, I don't know why, of Facebook like engineers in our investing club that we run. And that is a good representative profile of people who they need the data, you know, like they want to see it on paper, and they will grill us about why a certain project, like a syndication that we're investing in, is going to play out according to the business plan that it states on paper. And I like that. I mean, I really do appreciate that, because that means that if I can't back it up, then why am I putting my own money into it too? You know, so it's an interesting dynamic that I've observed, is that, you know, certain profiles of people with a heavily educated background, they really are not accepting of that idea at first.
It's not a main message. I mean, it's not a core message that most of us are brought up with.
Yeah.
That's right.
Yeah.
Completely.
Yeah, and it's hard to break that mold, right? Once you've been ingrained in it for so long, it's hard to get them out of that mindset. But man, when they do, it's very eye-opening.
Yeah, you better believe it.
So I want to go back, Spencer, to, you know, so you started investing passively. You were sharing it with, you know, people within your close network. How did you discover, hey, this is something that we can scale and actually make a business out of?
You know, I'm trying to think back to the exact moment when it happened. I think for me, it came down to putting down on paper the fact that, you know, we started with a 15-year time horizon for our own planning goals, where I was working full time, my wife's working full time, good cash income in working hard in these roles. But we wanted for financial independence. You know, we wanted truly to be able to go travel the world. Like our goals are pretty modest. We don't want to buy a jet. We don't need to have, you know, an army or an armada of Teslas. We just want to have, you know, enough financial wherewithal to be present as parents, to travel the world and have the option, right? So keeping that in mind, like we set a 15-year time horizon. And this is when we were still buying single family homes before we had kind of found syndications. And we started looking at that plan and going, man, that is just too long. And so we chopped it down and that kind of led us to multifamily investing. And once we got to multifamily and we started investing in these syndications, and I started just getting into conversations, and Jennifer started getting into conversations with people, the frequency of excitement when we would talk to most folks was pretty much, I think it was like 100% of the time we would get like people asking, oh, how do I learn more? Oh, can you send me that? And that's when it was like, okay, we have a business. Then we realized that after the first couple of deals, where it was really just, a small handful of immediate family investing, we then had referrals, and then the referrals were really where it changed for us. It came in second degree, or I should say second degree of connection from that first. And then the moment we got the first stranger coming in from that, we were like, wait, okay, now we should probably take this seriously. This is something where people we had no connection with prior are actually reaching out to us. They're asking us questions that are pretty hard hitting, but very legitimate. And they would come in and say, well, we'd like to deploy, what's your minimum? Is it 250,000? And we're like, well, it's quite a bit lower than that. And so in those moments, we're sitting there going, okay, so now we're talking to people that are pretty experienced investors, and they're not only taking us seriously, but they have faith in our abilities to vet these deals. And that is part of what we do is we vet the deals for ourselves anyways. So we built this framework that is the operator, the market, and the deal. We didn't come up with that. Lots of people talk about that framework. Within it, though, we got more specific and really tailored based on our own investing criteria. And that's where people started to get a lot more interest, I would say, because it made sense to them. Like the way we would vet deals seemed to make sense to them, and they wanted us to be their eyes on that deal and help educate them about why we felt like it was a good one. So yeah, it started with friends and family, second degree connections. That was like, okay, maybe we've got something here. Then it was like the first total stranger that came in, and then we were talking about very big capital amounts. It was like, yeah, we got to go do something.
Yeah. How long ago was that?
That was about 2.5 years ago.
2.5 years. So you've clearly well on your way to your goal versus 15 years.
Yeah, we're getting there. Yeah, we're really getting there. I mean, I at the time I never ever could have imagined that it would go this fast.
I like how your goal was actually, you started out with single family, you had a 15-year goal, and then you're like, how can we get there another way? We need a faster scaling mechanism. And that's usually the conclusion that people come to if they want to stay in the housing space in real estate.
Totally. Yeah. I mean, I think the benefit of putting stuff down on paper, I have found, is that you may not like if you really map out your current actions, your game plan you're running at any given time, right? You can get down and see something that you may not like. And I find that to be motivating. I don't find that to be soul crushing. I think some people have mentioned that when they go to plan and they're like, dude, they're like, Spence, I tried what you said. I put my acquisition plan on paper, and I looked how much the returns would be flowing in every month if I kept on buying single family or if I went and did syndications. And then they're like, it's going to take me 15, 20 years. And I'm like, okay, then what are you going to do differently? What are the assumptions you're going to change? Maybe that involves bigger changes. Maybe that even involves something like, maybe you have to relocate. Maybe you have to do something big. Maybe you have to, this is a real story. Like, I turned down 3 separate promotions in my W-2 career just to get the time and cap my hours so I could then go build my business on nights and weekends. And I turned down the prestige of fancier titles.
That's great.
It's hard. It's intimidating.
But you did what it took to, like you said, to scale your business, and that's.
But you had awesome. Your goal. You had your goal set, right? And so you're like, okay, I need the time to scale my business, and that's I have to make that work sacrifice, if you will, and the prestige and the whatever comes along with that glory.
Yeah, I think a lot of people really get hung up there, and I completely understand why. I'm not absolved of that. I'm not better than that or anything. It's purely just comes from. Trying to squash that ego that we all have inside of us to the tiniest possible amount.
So I want to go back, Spencer, and I want to really appeal to, maybe the passive investors that are maybe listening. And can you teach us a little bit about how do we get started as a passive investor, and what should we be looking for to make sure that we're investing in the right group or right operator and so forth?
Yeah, absolutely. I think, so I mentioned this earlier. There's a commonly accepted 3-prong framework, and it's out there very, very, very commonly. And that's the operator, the market, and the deal. Sometimes that terminology on the who throws people off a little bit when they're first getting into this. So when you hear me say operator, it also means sponsor. You can also just say team. You're basically vetting the who. And of the three, I gotta say, one of my bones to pick with the broader real estate investing community is that it sometimes isn't made clear enough, I think, that is the most heavily weighted vetting criteria of all three, right? I mean, the market, clearly it's important. The deal, critically important. Are you going to go vet those things? Yeah, of course you are. And you shouldn't go and put any money into any deal until you feel really great about all three of those things. And I'll go briefly in an example or two if you want within each bucket, but I'll just say that the relative weighting of those three is really heavy on the who. And it's because, you basically you can use a metaphor of a train, of a truck, of whatever vehicle you like, a rocket ship. Whoever's piloting that thing is going to largely determine the course. And right now, more than ever, heading into this bear market, not the bull market, the people at the wheel are going to be the biggest determinant as to whether or not the returns on that offering memorandum, on that investment summary that looks beautiful, has all those graphics, has all those wonderful things, and has some pretty big numbers on it for returns. It's going to come down to the who. And so, the way that we actually do that is, I won't go into our whole spreadsheet, but we use this thing, and I really use it as a guide right now in front of me. We look at the track record, we look at the approach, we look at the team, we look at the comms, and we actually look at their values. Not a lot of folks out there from a passive investing perspective care enough to go look at the values, but I'm a very big values leader from my corporate career. And that kind of stuff matters. And it matters now, I would argue, and I mean this in the last 2 weeks, matters now more than ever, because so many of these projects that have been kicked off in the past 1 year, 2 years, the tenant relations component just got a massive upgrade in importance. So, I sure hope that the operators out there are thinking about how they can get proactive and compassionate and communicate and really think about how people can feel welcome and taken care of in these challenging times, because there is a bottom line impact too. It's not just about doing touchy-feely stuff, and ice cream socials. It's also about actually making sure people want to stick around, and figuring out, compromises in terms of setups on the finances and all that stuff. So I look at operator market deal. The one thing I would call out though, guys, in terms of vetting a track record for an operator would be, we look at something that I have branded. It might sound silly, but it's what we branded, which is a failure response. And I actually took it from my corporate career, because I used to hire a lot of people. I used to hire hundreds of folks, right, for building these teams. And it just simply means, I want to know before we invest our money, and I would encourage passive investors to think about this as well. Find out if that entrepreneur, that operator, has gone through a really challenging time. Like, when have they gotten figuratively kicked in the teeth in their entrepreneurship career? Because there's operators of every experience level that are currently out there, and we work with ones that that are largely experienced. But I would say there's still a range for how much experience they have, and if they haven't been through a really challenging time that has challenged them to their core, so, and that doesn't necessarily always mean a capital call. Like, they haven't gone through investing in a passive or managing a passive deal and having to go back and ask the investors for more money just to finish the darn thing. But if they have gone through something that's challenging, it's challenged them to their core, I want to know that they have good decisioning under duress. And that is just so darn critical. So I won't necessarily want to go too deep on the other ones unless you guys think we have time to go there. But that's really the most important areas that I think we look at.
Yeah, that's a great point, and you don't hear that being spoken about very often. So I'm glad you brought that up. You definitely want to make sure that you're working with somebody that has good morals and good ethics, right? And I'm sure that plays into that failure response, right? How do they handle, like you said, that adversity, and do they put the people and the investors first?
That's right.
So,
actually, I would like to see if you can go a little bit more detail, if
Cool.
you want to do that right now, Cody, or I'm sorry, Spencer, into some of those other buckets, because I really like your framework so far. So I'm curious to hear more.
Yeah, no, happy to. Usually I just try to kind of be careful that I don't get too nerdy. But I'm always happy to get nerdier.
No, please, let's
Like,
bring it on.
it's like kind of like be careful what you wish for, but you got it. So, staying under the operator for one more moment, we talked about the 5 big buckets: track record, approach, team, values, comms. Under approach, I think that when it comes to contingency planning, again, I'm going to keep bringing this up, and it's beating a dead horse to a degree, but I think it's the right one to be, which is we're going into a pretty unprecedented period of time historically. As of this recording, I mean, we have a lot of folks out there doing their best, including the big real estate brokerage houses. Got Marcus and Millichap, or even like the other firms like Yardi. They're trying to do their best to get out reports that use fresh data that's gathered for the last couple of weeks. And so they're trying to basically come up with things that'll help inform future investment decision-making and acquisitions within real estate. But we're never going to perfectly know what the future is going to bring, right? At any given time, whether it's coronavirus time, whether it's pre or post, or whatever the world might bring. So contingency planning is a big deal. And so we want to play out a little bit when talking to a sponsor. How do you think about if stuff doesn't go so rosy? And, walk us through, tell me about a time when. And that framing right there, that verbiage of tell me about a time when, is stolen directly from behavioral interviewing within my corporate career, across those 5 companies, is just tell me about a time when. No one likes getting those questions. Yeah. I mean, I'm sure you guys have both had it, but those are the scariest questions in an interview for sure. And if when you get those, you're like, wait a sec, I can't really dance around this one. I have to use facts. I have to actually bring up details. And it gets even better when you start asking follow-up questions like, oh, that's interesting. Tell me more. And so contingency planning, critically important. I think last but not least on the team, before we go over to the market and the deal, the way that a partnership within a GP, if you hear the term GP, passive investors, that just simply is another way of saying general partnership, or the sponsorship team, the active managers of the deal. You want to make sure they get along, and you want to make sure that they actually have clear roles and responsibilities. There's nothing worse than watching people get at each other's throats, and you're powerless. As an LP, you're sitting there with your money in the deal, and you need to have faith in this team that is going to go do what they need to do, and do it productively. And there are times when teams implode, and they implode because they don't know how to reconcile challenges around, oh, wait, I thought that person was doing all the investor relations. Oh, wait, I thought that person was in charge of the construction. If it's a value add project, who's in charge of managing that project, right? Who's in charge of doing all the underwriting and doing the final say on the financials and the quarterly reporting? All these things, man, does roles and responsibilities matter, and it matters a lot. So, I nerded out pretty hard on the team. Looking over at the market, man, I think right now it's going to be tricky to pin down some of the key fundamentals. That term fundamentals is something you'll hear in the real estate circles often. And what that typically means is demographics, population growth or decline. You're really looking for places that are going to keep growing. You want growth, population growth. And you also want to have job supply. And so, jobs, population growth, these are some of the fundamentals that you're really looking for. And a key takeaway from this, which I can take no credit for, guys, I didn't come up with this in a vacuum. I mean, I was educated by the brilliant people that came before me, so I can't take any credit for this, but I just applied it and refined it for our own use case. But I would say you got to look at the broad market. So we've done a lot of deals, for example, in Dallas, Fort Worth. So if you were to just go in and we were to take a look and say, man, I would love to go invest in a project with some really capable sponsors in the Dallas Fort Worth area. Well, as a dumbass out of touch Californian, I would say, in all fairness, I did live outside of California for 10 years, so I'm not that bad. But I would say that I didn't used to know 5 years ago how big Dallas is. Yeah. Dallas it's like the size of a country.
Yeah.
It is freaking enormous. And I think someone told me there's like 170 cities individually within the Dallas MSA. And so metropolitan statistical area, big area around a city. So we look at that, but then it's not just that big footprint. we really have to look down at the neighborhood. And you hear the term submarket thrown around a lot. I didn't used to understand that before we got into this business, and we started really passively investing often in building our criteria. And you got to look all the way down to the neighborhood, and you can, technology makes this very readily available, not just with Google Street View. I mean, you can go out and like look at reviews done by tenants of the property. You can go down and even, we have used this service in the past, by the way. I haven't used it in a while, but there's even services called like wegolook.com. You pay someone, they go out with an iPhone, they take videos of the block and pictures, and they do a 2-page written summary. Like there's all these different things, and you can look at income levels. You can look at crime rates, and you want to see healthy crime rate trends. These are all the things that you can look at on the market. And it really is down to the block. I mean, even in the last 2 weeks, I would say one of the big changes that COVID-19 has driven from a lending perspective is that they want to know down to the block, like where are these operators buying? It does get down block to block depending on the lender that you're working with. So it's, the market got to go high level, got to go low level, all the way down to the block and to the neighborhood. Last but not least, we personally look for year one cash flow on the deal. And said in layman's terms, that just simply means we want to see that the project is spitting off or producing, quarterly or monthly profit that pays out and will begin paying out within the first year. It doesn't necessarily always need to happen on day one, but we do want to see it in the first year. And that's what you can refer back to as buying for cash flow.
Are you typically looking at B, A, what class, and what are some? Well, I guess prior to this, what were some of your investment criteria on returns and cash flow?
Yeah, and I guess prior to this is a great qualifier because it's all in flux, right? I would say we have gone particularly for B plus, and then occasionally looking upward a bit toward A. We have done 2 C-class deals in the past 3 years as well. But I would say our bread and butter is really like B plus, multifamily, 150 units or more. I would say that the annualized returns that we were seeing a lot of times, this is pre-coronavirus, was like 18+%. And I'm trying to think of anything else without getting too complicated at this point. That probably sums it up. I would just say the cash on cash returns, meaning if I put 50K in and on average, it's going to be coming in at like 8%. That means that it's going to be paying me back something like, $333 per month throughout the whole period. And a lot of these times, these are typically structured as big apartment buildings, 150 plus units. You're going to go into a value add playbook, and that just means you're going to go and renovate the thing. Interior renovations usually, exterior renovations, new coats of paint, a lot of stuff on the amenities, reposition it, which is a very real estate way of saying you're going to building a new name that is more marketable, and it sounds much cooler usually because you're trying to attract certain types of tenants. So you do all these things, and within about 3 years, you've got a more marketable and actually a higher value price point property. So that 8% flows in throughout the life of the deal that we invest in, and then at the tail end, the plan is to sell the thing and at a higher value, and then you get a cut of the sales proceeds. And so at the end, and that bumps it back up to that really kind of fun and sexy sounding 18 or 20% plus return, annualized return.
For the listeners, Spencer, would you mind going back and alluding to or defining what those class of multifamily is, A, B, C, D, just briefly, and then why you chose B class as your investment preference, excuse me.
Sure. Yeah. So A class, a quick comment on this too. I think one of the things that I really struggled with when I first switched over from tech, is I was a guy with a heavy operations and even compliance background. And I used to think, man, where's like the really clear cut scientific breakdown of what A class, B class, and C class is? and I would imagine you guys are trying. Yeah, I mean, it's a gray line. And, that might break some hearts of people in real estate that are like, no, I know what an A class is. No, I know what a B class is. And it's like, I know you do, brother, but compare that to places that are hyper data driven, then it's pretty gray. So A is luxury. A is just defined as something that, you're going to see smart home technology sometimes. You're going to see investments like that. Usually there's going to be a pool. There's going to be maybe a gym that's nice and clean. It's going to be for people that have strong incomes. So that is your typical A. The B is more like people who are, still working in roles that are considered probably like white collar roles. Sometimes it depends on the market that you're in, but it's a mix. And it's still going to be very comfortable place to live that is going to have like, some amenities. It's going to have like probably gym facilities. It's going to have, really clean landscaping, going to be a very safe neighborhood, all that stuff. And then C class, right beneath that is going to be like workforce housing for people that are more in service trades, people that are getting more, that are living more paycheck to paycheck. And I would say that from a risk profile perspective, there is a higher risk reward as you kind of go down that ABC. And one of the reasons that we have gone specifically for B is because that is the sweet spot. It has been the sweet spot. I will say, I don't know if it will be the sweet spot, but it has been the sweet spot for the past maybe decade, where you could go in and invest with a value add strategy from a construction perspective, do some, whatever the property in varying levels, you can go in and deploy the right amount of capital, the right amount of construction, the right amount of rehab or renovations. And you're going to see a really nice increase in the value of that property on the market. And you're also going to see that you can bring the rents up responsibly, not to become the market leader, but like just a couple clicks beneath the market leader on rents, so that it produces great cash flow and is sellable at a very attractive increase in price point. And so B is a great balance there, where you're not about to go take a big leap down to C class, where property management is a very different animal for C class. The renovations are going to be quite a bit more challenging, right? In some cases, you might find, like we literally had a deal that we were investing in, and we were just LPs in this deal just a few months ago. And lo and behold, the sponsor we were investing with found about $2 million in deferred maintenance with I think it was like a sewer lateral. And it basically fell apart. The deal fell apart because it was different than they originally inspected it for. So you find some surprises in C class, and you could definitely get higher cash returns with it, but you just got to know what you're getting into. And you certainly, if you're investing with someone who's managing that project and you're only passive, you got to make sure that they've done it before. And if they haven't done it before, I hope that they're bringing someone in who has done it before, so that they can help navigate all the surprises, because experience is just irreplaceable. One comment on the A class I would say is that you don't always see as much of a renovation focus on A class, because it's A class. A class is one thing I didn't comment on really as I went through those three ABCs is the year they were built. I would say one of the things that is a bit cleaner in terms of designating ABC is just I thought this was interesting when I first got into real estate is, they're referred to as vintages, right? So you got the age of the property, it's a vintage. Sounds like a wine. It's like newer builds are A class. You got 80s builds maybe would be B class, and it's not black and white. It's very gray, just like John was saying. So it's just good to take note of those things. But A class is not usually going to see as much of a value add on the renovations front, because it's a relatively new building, usually doesn't need a bunch of improvements like that, but you can still go in and do more aesthetic and a couple functional improvements to do a value add strategy on those.
I appreciate you elaborating on that, just in case there's anybody that may be new as a passive investor jumping on the podcast and they're hearing that term, what B class, C class, what is that? I appreciate you elaborating on that. So, and it's important for a passive investor to know what they're investing in, right? What their risk tolerance is,
Totally. It's a great question.
So from a passive investor standpoint, what are some things from a operator that what are the types of communication that you like to hear from an operator that makes you feel a little bit more confident in working with that one?
Yeah. Oh man, communication is the backbone. It really is. We've actually invested largely in, I would say, sponsors that are really great at communication. Only one time so far in our investing career within commercial, not residential, but commercial, have we had a sponsor that we've worked with, and I'll leave them unnamed, of course. I don't want to be disrespectful, but where I was kind of confused why they weren't sending more updates. And I would just say that what we are looking for at this day and age is just relatively frequent communications. And so a lot of sponsors are now doing monthly. They'll do a monthly MailChimp, and they'll tell you the key information. If it's a multifamily project specifically, and they're doing any types of renovations, you want to know, okay, how are the renovations trending? How many units? If it's a couple hundred units, how many units have actually been renovated? And is it on track for the plan that has been explained up front? And is the building as full as it needs to be, or as it's expected to be? And another way of saying that is, of course, the occupancy rate. So those are a couple of the metrics that you can actually look at and really track. And it's just important to keep a good beat on whether you're active and certainly if you're passive. If you're not at least quarterly going to see something written from the sponsors you're investing with, then it might not be a great fit. At least not for our capital, for my capital, because you want to keep track of what's happening still, and ask real questions along the way. I do think, just one more comment I want to make on that is, like, in terms of bad news, I think the last 2 to 4 weeks has been a whirlwind for anyone within the real estate world. I haven't sent more MailChimps on the active side of our business than I have in the past month, ever. And that comes from a place of really, really, really caring that our co-investors who invest alongside us into these deals that we use for our own wealth plan along with them. I'm sending, I don't know, 3 to 4 emails just for each individual deal. So we're talking cumulatively like dozens of emails going out in the past few weeks to bring people along and say, hey, there's a pandemic, it's global. That's crazy, right? I mean, I didn't actually write that, but it was far more business polished and it had some data behind it and all that good stuff. But in essence, what I'm paraphrasing and saying to these investors who deserve clarity is, hey, we're on top of it. The team is looking into the following things. Here's what we know, and here's also what we don't know, but we expect to know. Like right now more than ever, there are things that you can take a look at, even though it may not seem immediately evident. Such as, like, you can find out, do people intend to continue living in a certain building? You can literally just ask them. You could do a survey. You can go do a lease audit. Lease audits are pretty trendy in the last 2 weeks. And so for all the right reasons, people are trying to figure out, well, do we really, like, how likely is it that people are going to stop paying rent because of all these changes regulation wise that are coming out? So all those things are really, really, really critical right now more than ever if I'm a passive investor and I want to just know that the sponsors are looking at it and telling us.
So monthly is the gold standard.
Monthly is the gold standard.
And then if there's a pandemic, every week.
Yeah, every hour. Oh my gosh.
I'm sure it feels that way, huh?
It certainly is a change of pace. I've been having to block some extra time on the weekends just to do MailChimp time.
Well, Spencer, we've been spending a lot of time talking about, your passive investment business and whatnot, but tell us a little bit more about what you're doing on the active side. How are you participating in the GP side now?
Yeah, so we are a co-sponsor, and I would just say that if anyone is ever curious about, active participation in real estate, I would just say that, like, it's so important to play to strength and take stock of your geography as well as take stock of what you like doing. So I say that because 4 years ago, a mentor, when I was signing up for the first of many different coaching programs I've used 4 within real estate at this point, just commercial real estate. And I was about to charge head first down a track to become a lead sponsor. I wanted to be the guy. I wanted to be the next, pull a big name out, maybe Grant Cardone or otherwise. And I wanted to be that person. Right. And then I had a mentor that got on a call with me, and I told him what I wanted to do. And he said, Spence, you got to think about the fact you are in what people in real estate call a money state. You're not in a deal state. And I was like, well, okay, you're kind of crushing my dreams, but okay. And I'm so thankful for that feedback. He really did. It stung when he gave that feedback to me, but that prompted me to go take a hard look at what makes sense. And I bring up that context, guys, just because we know how to do partnerships and build relationships really well, because I did a lot of business development and partnership stuff in my previous career. We know how to do the analytics and the spreadsheet stuff. We know how to go and just really, really structure things in a clearly communicative way, as well as I used to do a lot of CRM work, email automation, all that stuff. So those are the values we can bring when we join inside of a GP team with a sponsor, and we've built that really thorough relationship with them. And we even put our own money in with them as LPs, as passive investors, before we decide to go join with them, because we really want to see that they walk the walk. We then get in and we help do things like raise equity capital, and we help do investor relations, and we get involved in the due diligence, and we get involved in the operations throughout the life of the deal. So we join with them, and we become one GP team on a deal by deal basis with a very, very short list of partners that we've built really good relationships with and spent money with and invested money with, because that's you got to make sure that you get to know the folks that you're going to kind of go and work with. So hopefully I didn't fly too fast and nerdy on that one.
Oh man, you're good. You're good. So what's
I
next?
love it. A deal state versus a money state. I mean, that's so simple, but powerful.
It really breaks the hearts of some of my very good friends that work in the real estate industry out here, and they're like, I'm like, I know it's a way gross oversimplification. There's plenty of people that put together excellent deals in California. I dare them to show me one that has better cash flow than some of the stuff you see coming out of like Alabama or like, or South Carolina or North Carolina. It's just not, it's a non-starter.
Absolutely. Absolutely. So what's on the horizon for you, Spencer? What's next for you? You've been able to step away from the W-2 and now do this full time with your family. What's next for you?
Yeah, I think the big project for us right now, and this is actually relatively well timed, is currently working on an ebook. I've been putting that off for like 3 years. So that's a work in progress. Going to be coming out with that later this year, and it's actually going to come from more of a place of, I think that people are looking for a holistic answer about how they play financial offense and financial defense. And I don't know if you guys have gone through this in your own journeys in real estate, but for me, I read 24 books. I listened to 400 plus podcasts, and I went way deeper down the rabbit hole on the content than I really needed to in hindsight. I was kind of crazy. I was like so into it, like literally listening to podcasts while I was running long distance, training for races and stuff. And I could have done it so much more efficiently if someone had just broken it down for me in a way, in a nicely packaged way. And so that's the kind of stuff that I want to work on. I don't have a coaching program necessarily. I am certainly thinking about it, but we're very good at what we do as a co-sponsor. And I get such joy out of not only working on a financial plan for our family, but just by doing that, we get to help other people find this asset class that they had no idea about. Yep. So I find that deeply enriching, man. And it's just, it's a blast. So I think there are a couple, I would say there's a couple educational things we're going to be baking into how we help people. And that just means accelerating the learning curve so it doesn't hit them so hard. Like a lot of people really struggle with wrapping their minds around the fact that you can invest and get a piece of an apartment building, and that's actually easier than going and buying a single family home and renting it out. It just blows the mind, And so if there's a way we can just shorten that education process, I think that more people will be able to benefit from it sooner. And I don't think people are going to want to miss out on the fact that excellent opportunities are going to come on the other side of this really, really challenging time.
Yep. Yeah. No, that's great. And, we'll definitely be looking forward to that. You'll have to let us know when you get that content out there. We'd be anxious to dive into that.
I just signed up on your website, by the way.
Oh, good. Please do. That's awesome.
Well, Spencer, man, this has been a great conversation, and unfortunately, we're kind of getting near the end of our time here. But man, we appreciate all the knowledge shared, and this has been just an absolute full nugget type of interview. So we appreciate that.
Certainly.
So,
Yeah, thank you so much.
Before we
guys.
go,
Really
I have a few
appreciate
more questions for you, if that's okay, and then we'll wrap up.
Yeah, hit me.
Cool. So listen, tell us, what do you do for your continued education and learning to further your investing?
Yeah, so I actually am just now signing up for another coaching program. It's actually the most I've ever invested personally, money-wise, in terms of a coaching program. And so that was a big move. And I even got feedback from the coach. He's like, dude, you guys are further along than you really need to. Like, he's like, why do you think you need this coaching program? And I'm like, I got to tell you, it's not an ego thing. And I think a lot of times people think that they get to a certain plateau or a certain level, and that they don't need to learn anymore. Yeah. And gosh, that's a dangerous place to be. So I'm investing in a coaching program. I am so fired up about doing it, and so I'm doing that. Also, I try to just, coach and mentor more informally, because I get reached out to a lot now, which is still kind of surreal for me on the real estate coaching front. So I don't necessarily do paid coaching, but I do like to do a lot of kind of ad hoc, pro bono coaching and doing all that kind of stuff. Joining a mastermind, I've put that off for quite a while. The term mastermind, if anyone is trying to beef up their learning and accelerate their learning curve in real estate, that term I found rather distancing. Honestly, like when I first got into real estate, I thought it sounded super stupid. And I got to say, masterminds are pretty amazing. And I totally judged them wrong. And so I think it's just worth mentioning the mastermind should be looked at, totally considered. And right now, more than ever, the sense of community and the sense of positive energy surrounding us all is going to be so darn helpful while facing headwinds.
Who would you say has been the biggest inspiration for you and your success so far?
Whew. I mean, I probably would have to say my dad, first and foremost, because he was able to get through all that hardship I talked about up front and still come out the other side with such a successful life. My wife, because not only does she put up with me, but also we really truly own our successes together. And I think a lot of couples, they don't understand how hard it was to get there sometimes, in terms of like really challenging, tough discussions together. While she built her career, I built my career, and then here we are together, co-founding a company together. I would just encourage people, don't shy away from that, because it enriches everything about your life if you can figure out that dynamic, if you have a significant other in your life and you're willing to go down that rabbit hole with them.
Nice. So you've given us a ton of advice so far, but I'm going to ask you, if you can give one piece of advice to listeners to help them grow their business, what would it be?
It would be figure out your personal story. And what I mean by that is, and I'll give a very specific example. When I first started going, I haven't gone on a ton of podcasts, which is why I'm so excited to go on with you guys. I've deliberately not gone on a bunch of podcasts and just kind of spray and pray, because I think that I see a lot of people doing that. And I think that what's important is be deliberate, and the story, more than anything else that you could spend time on to grow your business, you're going to need to constantly be growing and attracting more people to want to work with you. That's just, people love to go focus on the back end. I get it. The spreadsheet will not be the lifeblood of your business. Relationships and bringing in what's called the top of the marketing funnel and filling that with constantly new and interested folks, that is the lifeblood of your business. And so what is the best way to do that? Well, people want to know who you are. And people will find out who you are if you nail down your story. And I went on, I think 2 or 3 really, really prominent podcasts, like early on in my journey a couple of years ago. First one was with a guy I look up to immensely, with Rod Khleif. Yep. And people can even go on my website right now, on our website, and listen to that podcast. It was fine, showed up okay. But what didn't happen was I didn't dial in and workshop what's the emotional connection in the story, my story, and what are the challenges, and like how do I just be real, be raw, but be authentic, and so that people can track. so many folks get in there and they just say, well, here's what we're building and here's what I'm about, and go real estate. And I'm not being derogatory by any means.
Yeah.
I'm just saying that don't go out and try to book yourself on 100 podcasts. Go out and go back in the workshop and just think about what are the key connections and points and the takeaways from your own journey before you go out and you tell the world, because that is a much higher leveraged investment of time than most people realize. And when I've shared that with a couple of folks, they've gone out and then changed their own narrative. And keep it authentic. I'm not saying go manufacture something. Just be yourself is the point. Be more of yourself than you ever think that you needed to be. And then you will find yourself getting a better connection, and folks will start to attract to your business.
It's a great tip, man.
That's fantastic.
Yeah. All right, man. We'll tell the listeners how they can get connected with you and learn more about you.
Yeah. So we have a website, madisoninvesting.com. Folks can feel free to sign up or apply for our investing club. But they can also just reach out to me directly. Spencer at madisoninvesting.com. I'm also really active on LinkedIn specifically. And so if people want to follow me or really just connect with me, I'm always confused when people follow but don't connect on there. I'm just like, I'm not going to bite. You can just connect and follow my posts anytime, and they can reach out.
Nice. Well, Spencer, thank you again for spending time with us, man. And thank you for the value that you add to, the listeners and your investor database and out in the general public. And we look forward to hearing more from you and those eBooks and whatnot that you'll be working on. And we just really appreciate your time, man. Thank you.
Yeah. Thank you, John. Thank you, Cody. Really appreciate it.
Thanks for sharing your story.
Yeah. That's great. The next one.